Are you someone who actually invests in the stock markets but is not satisfied with the returns that you get? Are you someone who's actually also considered index investing but still it is not giving you the kind of return that you really seek from the stock markets? If you're that person, listen to me very carefully. My name is Arpit Arora. I'm the managing partner of Trendlines, which is a SEBI registered research analyst, and I have great news just for you. I want to tell you about the evolution of the stock markets first. See, there is a phenomenon that is happening. In the 1980s, when the stock markets were actually launched in India, for the first 10 years, everyone made money, irrespective if they had financial knowledge or acumen or not. Now, in the early 1990s, when the Harshad Mehta crash came, almost everyone lost their money because they were speculating, they weren't really investing. Now, that is when the mutual funds came into the picture and hand-holded people to make money in the stock markets. A whole 10 years of growth happened from there until the year 2000 when the dot-com bubble happened. The same story repeated itself, which actually gave way to ETFs or exchange trade funds, which were a replicate of the index or the index funds, you can say. Now, these were much more efficient, much more cost-effective, and most importantly, gave a lesser volatility and a higher return than most of the other mutual funds, making it a superior product. So the next 10 years was all about investing into index-based or ETF funds. From the 2010 to 2020, this time was completely all about investing in PMS, AIFs or boutique styles of investing, which gave a different way of investing into the equity markets, but not through the mutual funds, ahead and better than that of ETFs. But still, this is something that has been struggling in the last 2 to 3 years. Where we are right now is the year 2020. In the last 3 years, people who invested in the equity markets really haven't made much. And they want to know what to do next. What is going to be the next decade, the next era of investing? What is going to make them the money? And this is exactly what this video is all about. So we've been hearing a lot about the long-term investing strategy, the value investing strategy. There is a certain strategy that we've come up with, which is called short-term value investing. Now, this is a true blend between equity long-term holding and buying, as well as not buying it for the long term, but only buying it momentarily. So let me explain what I mean by that. When anyone buys from the value investing strategy, they actually wait for a good thing to fall down, buy it and leave it. With the scenario that is happening in the financial world these days, the corporate governance, the corporate actions of a certain entity, you really cannot know how long this company is going to be exist. Look at cases of Yes Bank, which is a prime case, by the way, Nifty 50 company, which today has lost its value from 400 rupees to even as low as 5 rupees. So a similar story has been seen in PC Jewelers and Bakirangi and many other stocks like that. The point I'm trying to make here is that you never know how long is the company going to sustain, what is the quality of their governance, how strong is the integrity and the ethics of the promoters of the company. What I'm trying to tell you is that the next 10 years is not going to be about this. It is going to be about value investing, but not for the long term, but for the short term. We've actually created a strategy in which you can invest in good, great companies falling down with good, great fundamentals, buy them at a certain price and not just hold it till eternity, but be able to sell it when it moves from the discount until the fair value. When you're able to sell it at fair value, sit in cash again, and try to repeat the same story. A lot of people would think this is trading, but it is not. This strategy is actually all about seasonal investing, or you can say swing investing. So this really helps an individual in terms of getting a high rate of internal rate of return, because your money always churns and rotates. So you can potentially rotate the same amount of money 3 times, sometimes even 4 times within the same year. So if you were to get 20% in a year, you will actually end up getting 30 or 40% because you are rotating the same amount of money into different entities. So this, we believe, is going to be the next 10 years is going to be all about a new, unique way of investing, and this, we believe, is going to be the game changer. If you'd like to know more about this certain strategy, click on the link below. Read for yourself what S&P's report on the life of companies say, which actually has moved from 60 years to 15 years. Just 15 years, the average life of the top 500 companies of S&P. So with that thought process, click on the link below, have a look at what this strategy is, and let us know what you think.